February 2026. The headlines look like politics, but the market reads them like plumbing. On February 6th, the U.S. State Department announces fresh sanctions aimed squarely at Iran's illicit petroleum trade, naming entities, individuals, and identifying 14 shadow fleet vessels tied to the flow of Iranian petroleum, petroleum products, and petrochemicals. That's not just a press release, that's a coordinate drop. Because the shadow fleet isn't an idea, it's a supply line. And in markets, supply lines don't have to collapse to trigger a sell-off. Sometimes they only have to look touchable. Then the story tightens. In early February 2026, reporting describes the U.S. considering seizing additional tankers carrying Iranian oil. And the reason that matters is not the seizure itself. It's what traders instantly price: retaliation risk, shipping disruption risk, and the possibility that enforcement stops being paperwork and becomes operations. Oil doesn't wait for a shortage. Oil prices probability. After the report, oil ticks up, Brent rising about 1.5% to around $69.8, and WTI about 1.6% near $65, according to market coverage. And right there, before any production cut, before any official blockade, you get the first mechanical step of a crash. The risk premium appears. Not "we lost barrels," we might lose the ability to move them. That difference is everything. Because the shadow fleet is not only about barrels, it's about tradability, whether a barrel can be insured, financed, and delivered without poisoning whoever touches it. Now rewind 2 months. December 2025. This is where the crackdown turns from episodic to systematic. On December 18th, the U.S. Treasury announces additional pressure on Iran's sanctions-evading shadow fleet, targeting 29 vessels and their management firms, explicitly citing deceptive shipping practices and the movement of hundreds of millions of dollars worth of Iranian petroleum and petroleum products. Read that slowly. Vessels, management firms, deceptive practices. That's not "Iran is sanctioned." That's "these hulls, these managers, these nodes." And once nodes are named, the shadow market doesn't just get riskier, it gets narrower, because every designation forces the network to reroute, change flags, change shell companies, change brokers, change payment rails, while every counterparty that's still legal starts over-complying to stay safe. The oil can still exist. The oil can still be produced, but a portion of that oil becomes something traders fear most: stranded supply. Supply that's physically real, but financially radioactive. Now rewind again. October 2025. The drumbeat returns. The State Department announces another sanctions wave, targeting roughly 40 individuals, entities, and vessels tied to the trade of Iranian petroleum and petrochemicals, framing it as revenue flow that supports Tehran's activities. Here's the market truth. Sanctions aren't a single shock. They're a metronome. Every wave adds friction. Friction adds delay. Delay adds cost. Cost becomes a shortage in everything except geology. And shortages in market plumbing are the kind that trigger chain reactions. Because once oil is priced higher, even temporarily, markets immediately start pricing the second-order effect: inflation. Now rewind 1 more month. September 2025. Europe flips the board. On September 29th, the EU says it has reimposed restrictive measures against Iran via the snapback mechanism, restoring measures that had been lifted under the JCPOA framework. This matters because markets don't fear one jurisdiction. Markets fear synchronized compliance. The moment shipping services, trade finance, insurers, and counterparties in multiple regions all tighten at once. That's when the gray zone stops being a fog and starts being a spotlight. Now jump back to midsummer, July 2025. This is the first massive map drop. On July 30th, the U.S. Treasury calls it the largest Iran-related action since 2018, designating more than 50 individuals and entities and identifying more than 50 vessels tied to a vast shipping network. This is what markets understand instantly. When enforcement publishes a map, the market rewrites its cost structure. Brokers don't just take bigger fees, they demand bigger discounts. Banks don't just get cautious, they refuse. Insurers don't just raise premiums, they walk away. And now we hit the hidden accelerant that turns story into crash. June 2025. The lever is insurance. War risk insurance premiums for shipments into the Gulf reportedly jump, rising to around 0.5% of a ship's value from about 0.2 to 0.3% a week earlier, as risk perceptions grow around the Strait of Hormuz. That increase can add tens of thousands of dollars per day to voyage costs for large vessels. In finance terms, insurance is not a detail. It's a gating function. When the price of permission doubles, the market doesn't need a blockade to feel a blockade. It needs only uncertainty, because uncertainty is what drains liquidity first. And when liquidity drains, the repricing spreads. Now widen the lens, because the shadow fleet crackdown isn't happening in a vacuum. It lands on an Iranian economy already under stress. The IMF's October 2025 World Economic Outlook data shows Iran's inflation rate in the 40% range, with 2025 showing around 41.6% on the IMF data mapper, which signals a domestic economy where stability is expensive and policy mistakes are punished quickly. So when enforcement tightens, it doesn't just threaten oil revenues, it pressures the internal balance, currency stability, inflation expectations, and the cost of financing. The same barrel that props up external revenue also props up domestic calm. Now bring it back to the market crash chain, fast, clean, and brutal. Step 1. Tradability breaks first. Not production, tradability. A barrel can exist and still be unbuyable at scale if financing, insurance, and delivery become too risky. Step 2. Oil risk premium reprices. Even a small jump matters because oil is a macro tax. It spreads into shipping, food, and manufacturing. It doesn't stay in your gas tank. Step 3. Inflation expectations lift. And once inflation expectations lift, the market assumes central banks stay tight longer than you hoped. Step 4. Bonds move first. Because bonds price the future faster than equities, when inflation risk rises, yields become the first domino, and once yields shift, the discount rate for every risk asset shifts with it. Step 5. Risk-off spills into everything else. Equities don't need earnings to collapse, they only need the cost of money to rise. Credit doesn't need defaults today, it only needs default probability to reprice. And once the repricing starts, forced selling does what fear always does. It makes the move look inevitable. Now the final twist. What makes this episode feel like 2026, not just another sanctions story? In February 2026, analysis and expert warnings highlighted the environmental risk of aging shadow fleet tankers, often operating with limited oversight and potentially without adequate insurance, raising the possibility that a single incident could trigger a wave of tighter inspections, denials of port access, and even more aggressive enforcement. That is a second trigger sitting under the first one. Even if geopolitics cools, an accident can harden the system overnight, because after a disaster, tolerance collapses, and regulators don't negotiate with public outrage. So in 2026, this is the true Market Crashes Explained takeaway. Markets aren't just pricing conflict. They're pricing the moment the world decides the gray market is no longer worth the risk. And that's why a crash can start with a line in a sanctions notice, a spike in war risk premiums, and a tanker that suddenly can't dock anywhere. Not because oil vanished, because permission did.